now on. Okay, so welcome everybody to the first in our Spark Q4 Fireside Chat series. Lovely to welcome you all to the session, and even better to be joined by Elle Berrett this evening. So Elle has been in legal practice for just over 10 years, specialising in commercial law and working primarily with startups and early stage companies throughout that time. She's been at Rooks Ryder, Fletcher Day, and now is at the fabulous gunnercooke, which won Law Company of the Year at the Lawyer Awards 2020. So I'd like to just start this session first by asking you, Elle, to just tell us about some of the types of fundraising transactions that you've been involved in. Give us some colour around your experience.
Yeah, hi everybody. Yeah, good question to open with. So like Julie says, I've advised a lot of clients when it comes to fundraising. Excuse me, in all kinds of different sectors, some incredibly colourful indeed. So just to give you some examples, I've sort of advised clients from very early on, sort of very early seed stage, sort of Series A, Series B, and up to the much larger sort of private equity scale of a type of investment. I'm definitely not sector specific. So to give you some examples of the type of sectors and the type of clients that I've helped through the fundraise process, I've got clients ranging from sort of the restaurant sector, the hospitality sector, right through to sort of retail, high street retail and online retail, so sort of B2C and B2B. I've also dealt with a significant fundraise for an IT cybersecurity company, pharmaceutical sector, medical tourism, and fairly niche sort of bicycle and motorbike sector. I've actually dealt with some dragons on the other side of deals as well, which has been yeah, very colourful, if you want to put it that way. Not the most straightforward of investment rounds, but it's been a very good learning process. Yeah, so real mixed bag of clients that I've acted for and helped through the entire investment process, really.
Super. Okay, so tonight we're talking all about getting the legals right for your raise. And one of the first questions I wanted to ask you really was, at what stage should founders get the lawyers involved? Is it kind of wait till they've agreed a deal with an investor, or should it be earlier on in the process? What's the kind of best thing to do in your experience?
Yeah, that's a good question. It's a really good question. There's a fine line. I always tend to say to my clients, don't get me involved too early, because at the very early stage of the sort of commercial discussions, there's not a huge amount that me or any lawyer can particularly add at that stage. It's a lot more cost effective for clients to have early stage discussions, commercial discussions with an investor, and just simply talk through the commercials of the deal. So, you know, really basic stuff like, you know, how much are you looking for? What are you prepared to give away in return for that? Dealing with sort of dilution provisions, I'll come on to that a bit later, and things like that. Does the investor want to be day activities of the business, or would you rather they were a bit more of a silent investor? And all this is sort of discussions that you need to have as early on as you can, because if you don't deal with those things right from the outset, they're just going to crop up later on during the deal, which is just going to slow the whole process down. It's going to get lawyers getting involved in discussions that we don't really need to be getting involved with. That said, I would definitely and absolutely not turn any clients away from the outset, because I think it's also really important for founders to understand what's going to be involved in the process. So whilst I sort of tend to emphasize just get negotiating, get all your cards on the table, I'm always happy to handhold and actually talk the founder through what they should typically expect a little bit further down the line and at what point I would get involved.
Sure, and I guess the important thing is that at least they know which lawyer they're going to use, so that when they get to that point, that relationship already exists, and they can go straight into using that lawyer rather than finding an investor and then having to scrabble around and find a lawyer quickly.
Yeah, and it's, you know, it's good to do your own research on if you can get if you can be recommended to a lawyer that perhaps you've got a connection or a contact that have used somebody before, then that's great, because there's nothing better than word of mouth and personal recommendation. And you know, you need to just sort of shop around, have a look at previous experiences that lawyers have dealt with. Have they acted in your sector before? Have they advised founders on a deal similar to yours? What's the value? So do a little bit of research, but I think, you know, you can't really beat a personal recommendation either. So
sure. Okay. So we talked a little bit about just then about what founders might expect and the process itself. Can we expand a bit more into what the actual legal process parts are of the fundraising experience as a whole?
Yeah, absolutely. So it's a fairly long, I don't mean long, I don't want to put people off. It is a process, but it's got to be done that way to make sure that we are protecting your business and you. And as I said before, it's really important to sort of just have the early stage commercial conversations with investors, find the investor that you're comfortable with and go with them. What is next involved is the preparation of what we call a term sheet. And effectively that's heads of terms. It's headline commercial points that you've agreed and you've put it on paper with your investors. So things like, how much is the investment? What equity are they going to be taking in return? How many shares are you going to be giving to them? Any key points, you know, are they going to be appointed as a director, and things like that. And that's often not too heavily negotiated, but that's the absolute point where we as lawyers should get involved, because I think we'll probably be coming onto this a little bit later, but you don't want to go too far down the deal without getting your lawyers involved. And I know I said before, don't get us involved too early, but equally don't get us involved too late either. So typically when you've got the term sheet agreed or in draft form, that's when we should get involved, and we will then typically be introduced to the investor's lawyer, and the line of communication will then open. So once the term sheet has been agreed, your investor is going to want to do some due diligence on your company. Now, I always say to clients and founders, get ready for this. And I know that's something you always emphasize as well, Julie. But it's so important, because an investor is about to part with a lump of cash. They're not just going to hand it away willy-nilly, if you like. They're going to want to do their research on the company, and in doing so they will unravel a lot of things, everything. Sometimes obviously if you're fairly early stage startup, there might not be a huge amount of information that needs to be unraveled or looked into as such. But whether you're very early stage or whether you're much more advanced through your business's sort of life cycle, it's so important to get all your contracts in place. You may even have a couple of employees at that point or more. Get your contracts in order, get your contracts looked at, make sure they're watertight, make sure you're GDPR compliant and things like that. And actually that's something that I can also help you with, you know, either before the fundraise process or during the process. But it's a really, really important factor to get right. And typically the investor will send, or their lawyer will send, a due diligence questionnaire, and that could range from a couple of pages long to 25 pages long. And it's really crucial that you as a founder looking for that investment to answer those questions as fully and in as much detail as you can. And it could be things like, you know, some things just won't be relevant at all, which is absolutely fine, and you just say they're not relevant. So for example, they might want to know, you know, how many employees does the company have? Are you going through, are there any disputes at the moment with any shareholders, any employees? What contracts do you have in place? Are there any issues with any contracts? Who are your largest customers? Who are your largest suppliers? And they'll expect all this information to be to hand and ready to provide them with.
It's about building trust, isn't it? Because they're asking those questions and they expect you to be able to respond promptly and to show that everything is properly evidenced. So it's a key part of the deal.
Exactly. And a lot of investment rounds can collapse at this stage because investors just aren't comfortable with proceeding. So it's really important that I help you with that process as well, and sort of reply in the way that you would expect, in the way the investor would want you to. So once that stage is out the way, you then move on to drafting and negotiating the shareholder agreement, or the investment agreement. And that essentially is the binding contract between you and the investor. And that's the document that gets or can get fairly heavily negotiated. It very much depends on the size of the investment and the nature of the investor, really, and their lawyer. But this is a contract between you and the other investor, and it just typically sets out all the things that you've agreed with the investor in a contractual form. I don't know if you want me to go into too much about the legals and the particular things that you would need to think about. But just
I think if there are some key things that you think are super important, I think it would be great to share that level of insight.
Yeah, no, definitely. And I mean, I think this comes on to a bit later on, you know, what could go wrong, and what might derail the process, but I won't go too far into that. But key things, what happens in the event of a deadlock? What happens if there's just 2 of you or there's 4 of you and there's a deadlock situation and you as shareholders just can't agree how to move forward? The shareholders agreement will deal specifically with situations like that and how to move forward in that eventuality. And unfortunately, I've dealt with a lot of situations with founders who have got investment agreements in place or shareholders agreements in place that just aren't really robustly drafted, and it's just led to a huge dispute and the ultimate collapse of the company. So that's really, really key. It will also typically deal with how to deal with exiting the business. Again, this can always raise a little bit of a contentious point amongst shareholders and investors. How to realise your valuation of your shares. It's so important to have a mechanism in the investment agreement as to how to value that shareholding. Again, I've had some really sad situations with founders who have just come to loggerheads with investors because they just haven't been able to agree a way forward or how to exit the business, and it's just incredibly unfortunate that the business has had to just fold and everybody walked away with their heads hanging low. So we want to avoid all sorts of situations like that, really. So those are the sorts of things that get very heavily negotiated in the documents. Then there's disclosure, and put very, very simply, what this means is whatever information you're giving to the investor about your company, the investor can't then come back and claim against any of those things. You might not have anything to disclose to them. You might just be, you know, a freshly incorporated company with not too many issues going on there at all, in which case, great. Or you might be a founder who's a little bit more developed with their business, And you might, for example, let's say have a slightly rogue customer, or a slightly an employee who's going through a grievance process or something like that. Nothing that's going to collapse your business, but it's really important that you disclose information like that to the investor. And again, it's about building trust, so that you can both move forward successfully with your investment. And then the deal gets done, and then as lawyers we'll deal with all the post-completion formalities.
Super. Okay, we'll talk a bit more about the post-completion stuff later on in the session. One thing I just wanted to kind of dig into slightly was you mentioned when you're setting out the heads of terms, things that investors might want in the heads of terms, because obviously the company itself has things that they want in the heads of terms in terms of how much equity and how much money and everything else, but investors are typically coming to the table with things that they want included in the heads of terms. What are some of the common things that you see that investors demand go into that or indeed into the shareholder agreement?
I mean, again, very good question. One of the key things that investors always demand typically is being able to be appointed as a director, and then having the subsequent power to appoint other people as directors. And crucially, because they would often be coming in as a minority shareholder, in other words, as it stands, they don't have enough power to make key decisions that affect the company. It's all investors will come into a situation like this wanting additional control and additional rights in regards to the company. And what that means essentially is that you as the founder or as a director cannot make key decisions without that investor's input. And the reason they want this is effectively to protect their investment, so that you as a founder can't go ahead and make decisions without their input, so that they can have a say and make sure that everything that you do affecting the company is also in their best interests as well. So this could be anything from entering into a contract with a supplier over a certain value. It could be changing the company's articles. It could basically pretty much anything that affects the company that they don't want you to do single-handedly. And it's about striking a balance between how much control are you willing to give away to that investor. And that is often a very heavily negotiated point when it comes to drafting the documents.
Is there a kind of common threshold of over a certain percentage holding where it's more common for investors to expect that they'd be able to be a director? Like at 5%, they'd just accept that they're essentially a silent investor, but over a certain percentage they would expect to see it. Do you see a kind of common trend in that respect?
Yeah, there does tend to be. I mean, most of the fundraisers that I've worked on have generally been for a minimum of the sort of 8 to 10% equity, and I have never come across a situation where an investor hasn't wanted some or all of those things to be included, to be within their powers or their control. It's generally scheduled at the back of the shareholders agreement. I've had situations where there's been maybe 5 or 6 points affecting the company that the investor might want to be consulted on, and other deals that I've worked on, they have just been 4 or 5 pages, 6 pages long. It does tend to correlate. The more percentage equity they get, the more say they want to have in regards to the business. And I think most of the time where it does get very heavily negotiated is when you're not giving away much, but they want a lot in return. So yeah, it's I would say sort of an 8 to 10% mark tends to be where they would expect more.
Sure. Okay. So just kind of heading back into the sort of the legal process and your engagement with your lawyers, apart from the mechanisms of completing your shareholders agreement, completing the revised articles after that, what kind of additional value should you expect from your lawyers through that process to help you as a founder?
Yeah. Okay. So every lawyer, and I always do this. Every lawyer really needs to understand your business. When it comes to the point where you're happy to instruct your lawyer, I always take it upon myself to do my own due diligence on you and your business. What does your business do? Just really break it down. Who are the current directors? Who are the current shareholders? I wouldn't expect you to just drip feed me all of that information, because quite frankly, that's just a bit lazy. And for me to deliver a good job for you would mean me doing my homework as well. And I will have conversations with you, I will ask you questions, but all that's really, really important, right even before the deal gets going or before we get involved. And we're going to be working together. So you will see a lot of me or a lot of your lawyer. You'd be speaking to us pretty much all the time, because when these deals kick off, they're quite intense. So it's really important that you get along with your lawyer. I mean, it sounds really silly, but if a founder reaches out to me, or if a client reaches out to me, I will always make the time to take that call or call you back. It's really, really important. And you need to have these discussions with your lawyer. I will always have calls with my clients at the early stage of the transaction at no cost at all, because I think it's really important that your advisors, firstly, are able to act for you, because sometimes there might be a situation where there's a conflict, or it's just not possible for whatever reason for your lawyer to help you in a professional manner. And I personally never charge clients or founders for those early discussions or early calls, because I'm really trying to get to know you, like I say, and trying to get to know your business. So I think it's quite important to understand costs as well, with your lawyer, and where you stand, because for me, and I understand it from your point of view as the founder, it's really important. Cash flow can be an issue, particularly early on. So it's important for your advisors to understand your position as well, and I will always have discussions about that with you.
Yeah, I think it's something that we've certainly seen for some of our clients, where the lawyers have kind of misjudged who they're dealing with, and have pitched far too high. In terms of cost, or the founder has misjudged which type of lawyers to approach, and have perhaps gone to too big or too expensive a firm that would suit them 3 or 4 years down the line, but not in their first or second raise. So
absolutely,
I think finding the kind of size and shape of firm that can absolutely deal really effectively with what you want to do, but is also going to match your budget is absolutely critical. So
yeah, it is, and I think that's why it's so important to be really open and transparent, and that's how I deal with all of my clients and founders, is just to have a really open discussion with them. And it is a hand-holding exercise, and I don't mean that in a patronizing way at all. But the legal process can be quite daunting. You're dealing with hefty old documents. It's all kind of legal jargon, and it's important again that your advisor or I break it down for you and just explain each step of the process to you, and what it means exactly, and what to expect, and not to be surprised at some of the things that might get thrown back at us from the investor or their lawyer, because actually that's just normal, and we're here to negotiate that for you on your behalf. So it's about reassuring your client as well, and making them know that it's okay, and what to expect, and not be put off, but also helping them make sure that they are ready to sort of deal with the investor and give them the information that they need as well. So yeah, it's important to have good communication lines there, I think.
Yeah, I think one of the other things that you said that point about not being put off by some of the processes that happen. I think it's really important for founders to remember that the lawyers on each side are the guardians for the party that they stand for, that they represent. So it is their job to be fearsome at times, to ask the really hard questions, to push where perhaps the founder or the investor wouldn't in person do that, but it's their job to do that, to make sure that the deal is done properly and meets all the requirements for both sides.
That's true. And we're respectively, we're acting in your own interests. I've got to act, I want the best for you and the best for your business, and ultimately the investor's lawyer will want the best for the investor, and it is about reaching a point where you can negotiate the terms. And as lawyers, we are experienced and accustomed to deals of certain sizes and nature and what we would typically expect to see, and if we feel that something's gone a little bit above and beyond what we would normally expect to see, then it's our job to comfort you and throw it back to the investor or their lawyers. So we are there to help you and just to make sure that you're comfortable with what you're embarking on, essentially.
Sure. Okay, and just to mention to everyone who's watching, if you do have any questions, please do pop them into the chat, and we will pick those up at the end of the session. So feel free to ask any questions that arise as we go. Okay, so we've talked a lot about what the lawyers will do in the process. Let's turn to what the founders' responsibilities are, first of all. What are the key things that you expect from a founder as one of your clients? What do you need from them to enable you to do a good job?
Yeah. Okay. So help us help you, typically. Again, so I think you need to get your ducks in a row, and you need to make sure that you and your business is ready for the investment, and that's where Julie comes in. But what I would want to make sure that you've got in place, just to make sure that nothing gets derailed, that nothing puts the investors off or loses the investment, crucially. I mentioned earlier about not getting us involved too early, but don't get us involved too late either, because it can be really critical and a little bit dangerous and I've had examples of where this has happened, sadly, where clients have tried to cost cut perhaps a little bit too much, and have tried or embarked upon the fundraising process themselves without legal representation, and have started drafting the documentation themselves. When I got involved, it was a little bit too late, and the documents weren't in very good shape. The investor was getting very frustrated, tensions were building, and it all just got a little bit sensitive. And then, unfortunately, as well, for me to come in too late into the process involves me having to go back and sort of start afresh, which annoys the investor even more because it seems that we're wasting time. And I've had one or two situations where clients have tried to cut corners and tried to do a lot themselves. And I do understand the situation, I really do, because like I said before, cash flow can be problematic. You try and do things yourself, but to be honest with you, it's often not the best route to take. So that can really derail the process, unfortunately. I've mentioned this before, but I think it's important to reiterate that the due diligence process is really key, and I can help you with that. So I can help you get your company, your documents in good shape, If you don't have any terms and conditions in place, for examples, when it comes to dealing and providing your goods and services to customers, the investor's going to ask, well, why on earth haven't you got any of these contracts in place? We can get that done for you. Unfortunately, I've had situations where investors have had no choice but to walk away because they've just embarked on the due diligence process and have just been really disappointed and shocked as well, quite frankly, with what they've unearthed. And they've walked away. But I think from the investor's point of view, it's better to walk away at that point. Not that you want them to at all, but having made the investment and then realize that there's this, great gaping big liability in the company or something that you haven't told them about. So yeah, it's important to be really transparent with the investor, but get everything as ready as you can beforehand as well.
Sure. And it's also about the the founder's availability as well to push, because like you said, it can be a very intense process.
Yeah.
And of course, founders are absolutely focused on running their business and making sure they're still hitting their numbers, which is critical. Right. They can't let that drop, but they have to be available for for you and the process that's happening as well.
Definitely. Yeah, that's a really good point actually, because you as founders, you've got your business to run and grow during this investment process as well, and it's important that you continue to do that. And a little bit more about how I usually would add value as well, just going back a little bit, is I make time to speak to clients if they need to, if it's in the evening, if it's early morning. I get that you've got a business to run, and I would hope that your advisors can be flexible as well, and we understand your situation, we understand your position, so it's important that we try and work around that as well. But yeah, no, that's a very good point actually.
Okay, brilliant. So so staying on the founders side of the fence as well, what are some of the key mistakes that you've seen founders make that can derail the fundraise?
Yeah, well, I think I've touched on a couple of them, but one example that I can give you specifically is, and I think actually you alluded to this just now, is simply just being available. I mean, it sounds fairly obvious, but when I've got an investor or their lawyer on my back, I'm trying to get in touch with you and I can't get in touch with you and I don't know where you are, and I need to go through documents with you, I need to ask you questions. If you're not there, it makes the process very difficult. And I've had sort of clients that have known that there's a completion coming up or the funds are about to be transferred and they're nowhere to be found. And it sounds really silly, but even just things like that, if you know there's a deadline coming up in terms of your investment round, you kind of need to make sure that you're available. So I've had clients that have just sort of gone AWOL, which has been quite remarkable actually. So I'm getting it in one ear from the investor and then I don't really know what to say. So yeah, it sounds really obvious, but that's fairly key. And like I say, I've had a couple of clients who, I don't want to go over it again, but who've gone really far down the process with the investment themselves, and I think cutting corners is a really, really important point to make, because you can't cut corners when it comes to this process. You really can't. I've had a client recently who I quoted for to help him, to advise him through the fundraising process. And I always make sure that I'm proportionate. I'm never gonna go in, crazy quotes. And unfortunately, they wanted to cut my costs and cut corners and do a large part of the whole process themselves. And this is a client, a founder in the media sector. And unfortunately, they got so far down the line, the investor wasn't actually willing to proceed because the founder hadn't appointed a legal advisor to represent him on the investment. So he got so far down the road, and the investor just actually got to the point where he's had enough, because you do need two sets of legal eyes to go through everything. So please don't jeopardize that. Get us involved, and we don't have to get involved all the time, but just to know that we're there and we can help you is really important.
Yeah, and from the investor's perspective, they want to know that you've had proper legal representation, A, so that they're protected and that things have been done properly, and B, so that the founder can't later claim that things were unfair or they weren't aware of what things meant. So the investor thinks that's really important as well. It's not kind of just the founder that's saying I need legals. It comes from the investor side as well.
It really does. And actually, just on that point, you've made a good point that I was actually dealing with a situation last year where I had a founder client, really good guy, really sort of successful business, growing. His investor didn't take any of his own legal representation, and it was disastrous, absolutely disastrous, because I think the size of the deal, it wasn't huge. We're looking at sort of, I think it was about 400,000. I mean, it was significant enough, but the investor had no advice. So I had nobody to negotiate with, because I can't, my position is to act for you, the founders. I'm not in a position to start advising the investor. And the whole thing was absolutely disastrous, unfortunately. And the investor eventually disappeared off the face of the earth, and left my founder client with a legal bill that he can't settle, because the founder never invested the funds to pay our legal fees. So it does kind of go both ways as well. I think lawyers are a lot happier dealing with other lawyers as well. So although we might battle, it's actually really important to have that
structure in place.
Yeah.
And I guess it sends a cautionary tale that that founders should do their due diligence on the potential investors too. It's not a one-way street. They should do their own research and
100%.
really understand who they're getting into bed with.
Absolutely.
Like you say, people disappear into the wind or say things in early stages that then turn out not to quite be true.
Exactly. Very true.
Yeah, I mean, one of the key things that we've seen people have problems with is the money being when the money's actually going to be available.
Yes.
So that it's not always the founders going along with this lovely fuzzy feeling that as soon as the deal is signed, the money will be in the bank the next day, and that isn't always the case. I don't know if you've got sort of examples of when that happens.
I have actually, I do. Similar to the situation I just explained, but we had a situation where parties had progressed to the point of completion. So everybody was good to go, and then we were approaching completion that week, and the investors' lawyers, I would typically always ask the investor, please, let us know when the funds are in your client account, because it's usually done between lawyers' firms' accounts. The funds hadn't arrived. We're starting to get a little bit worried. Where are the funds? Well, quite often they might be remitted from offshore, or they might be kind of, we don't know. Two instances, actually, just to give you an example. One was, well, both are very unfortunate, but one, the founder was, unfortunately, I think the best way to sort of do it was sort of telling porcupines about where the money was and where it was coming from. It took weeks and weeks and weeks to go through the banking system to actually finally land in their lawyer's client account. We're talking about sort of 6 weeks later, which is fairly disastrous if you think about it. I mean, yeah, it's an incredibly frustrating. And secondly, we had a point actually where a large amount of investment funds were coming from offshore and were, this is a slightly unique situation, but just to give you an example, they were intercepted by a fraudster and never arrived. So there are things through the banking system. So there are things that can happen. They're very rare. But yes, it's important, and that's why it's important as well that your lawyers are on top of it and know exactly what's going on there. So yeah, no, that's a very good point.
Yeah, certainly. And I think other cases where we see it being slow for the money to arrive can be where it's a corporate venture capital arm, and because it's a large corporate, they have all of these processes in place that must be done in their exact way, and they can't run the money on any given day. It has to be on a certain day of the month, and that can delay things massively. And I've certainly spoken to sort of leaders of those corporate venture capital arms who've said, we're getting much better at the speed of the deal, but we're still really slow at getting the money across. That's there, so I think it's vital that founders understand those questions early on, because they could be budgeting on, oh great, as soon as the deal's signed, we start on our 90-day plan post investment, and actually you might not be able to because you haven't got the cash straight away. Or
no, absolutely, that's really important. And it's actually acting for the founders. I always open that discussion with the investors' lawyers fairly early on. So I will ask, where are the funds coming from? Where are they being sourced from? And and because of previous experiences that I've cited, I know that can be tricky and it can cause a delay. So I will then sort of say, perhaps every few weeks or every 3 weeks into the process, just checking that arrangements are in place for your client investor to get monies across. And as soon as a lawyer as well, acting for you, the founders, the minute we know that the investment funds are in the investor's solicitor's client account, I almost breathe a sigh of relief, because I know they're just there. And then whenever we get to completion, it's just going to be done on the day.
It's the same as when you buy a house, isn't it? Knowing that all the funds are there is the point when you go, great, we're there.
It
very,
is
very similar.
And it's a relief for us as well, because we don't like being the bearer of bad news to founders, and nobody likes a chasing process. So it's important to just get that out in the open early on.
Sure. So talking about, you mentioned there, that kind of every few weeks through the process, you'd be checking in. So what's your, and obviously this will probably vary massively depending upon the stage of the company and how complex the deal is, but is there a kind of typical length for the legal side? So say from heads of terms being agreed to cash in the bank, what sort of would be your expectations as a minimum and a maximum range?
Without trying to not answer that question, it varies very much. I think it's important for me to make sure that founders are realistic about the process. I think the quickest I've ever done an investment from sort of term sheet right up to the point of cash is in your account is probably about 4 to 6 weeks. And it's I mean, you need to allow time, because there's a lot of negotiation that goes on around the documents. And again, it really depends on the investor. You might get an investor that comes along who's really going through it's the due diligence that can take the longest period of time. So typically, an investor might come along with a fine-tooth comb and just unpick everything. But in order to help speed that up, I will help you in responding to their questions, so that they don't have to keep coming back with more questions. And because I know the sorts of things that they are wanting to know and answers that they are wanting to be provided with, I can help you with that, and try and speed up the process. I mean, I think I would say on average, it's a good, yeah, sorry, did I say 4 to 6 weeks? I'd say probably 4 weeks is the quickest I've ever done one in, but that was a very intense process. I think typically you're looking at a minimum of about 8 weeks to go through it on average. On average. Sure. But again, you know, depending on the size of your business and the size of the investment, it's, you know, how long's a piece of string, really.
Yeah.
But,
yeah, so the more complex you are, and the more data that you've generated as well.
That's
so
right.
as you get later and later stage, and you've got more and more clients and suppliers and all of those things, then it's more due diligence weight, as it were, to manage through.
It is exactly. And we can, as lawyers, we can go through the legal documentation process, you know, as quickly as you want us to, or as we can, but really it's until that investor gets comfortable, then they're not going to want to go any quicker, really. So that's it does come down to DD, due diligence.
Yeah, sure. Okay. So we've talked a lot about getting the cash in, which is the thing that the founders look forward to.
Yeah.
But what else legal wise needs to happen, you know, after the deal's done and you've got the cash? That you know, things that, you know, mustn't be forgotten.
Yeah, absolutely. There are things, sort of boring post-completion formalities that us as lawyers would typically take care of, so you can go off and sort of start growing your business. Yes, so obviously shares would typically be issued to the new investor, and there is some paperwork to deal with around that. So we would have to make relevant filings with Companies House. We will need to make sure that those documents are sent to Companies House, but that there is a time limit. If you don't send those back to Companies House within the required time limit, you could face, or the company could face, a penalty. So it's really important that once the deal's done, it's not completely over just yet. We would need to file the new articles with Companies House, and there's the resolutions, the shareholder resolutions that go with that need to be filed as well within a fairly narrow window, actually. So it's important that your advisors stay on top of all of that. And actually what I normally do is I create a sort of a post-completion checklist for founders, with the associated sort of timeframes in which we have to do things. Because it's great, it's all good and well, the process has gone well, you've got your funds, you can go off and celebrate and start collaborating with your investor, but don't forget the small detail. The worst thing you want is your investor to think, well, why on earth haven't you gone and done all this stuff? Why aren't your lawyers on top of this? That's actually quite embarrassing. So yeah, it's not a good start, is it, when you've just got their cash, to then not follow through with key stuff like that. Exactly. And it's rejigging the share capital is important, and making sure that's drafted correctly, and updating the company's registries, statutory books as well.
Sure. And you just mentioned the articles that needed to be filed because changes have been made.
Yes.
So just explain a bit about, you know, obviously there's a shareholders agreement that's been signed, but the impact of that on the articles of association for the company, because a lot of new startups will start with just a bog standard articles, and then suddenly changes have to be made that actually affect the running of the company.
Yes, yeah, absolutely. So it can appear a bit confusing, because you've got the company's articles, like you say, and then you've also got your shareholders agreement. Now, typically the way I try and explain it to founders is that the articles of association they represent sort of the constitution of the company, what the company can and can't do. And it's important that anything that affects the shares or the share capital are reflected in those articles. So the articles should really dovetail with the key provisions in your shareholders agreement. Now you need to remember as well that the shareholders agreement is a private contract, essentially, between you and the investor, or you and the investor and the other shareholders. That's not publicly available at Companies House. So that document is private, but the generic changes that are involved in the shareholders agreement, so it could be things like how to deal with transferring shares, or are there sort of drag and tag rights, we would need to reflect those as well in the articles. Otherwise there could be a conflict there, and it's arguable which should prevail, whether it should be the shareholders agreement or the articles. So it's important that they tally up nicely.
Sure. Could you just expand slightly on what drag and tag rights are, because that's a bit of a complex area that people might not have come across before.
Sorry, yeah, legal talk. So essentially, quite often when you've got an investor or another shareholder in your business, they will talk about sort of drag and tag rights. And what those mean essentially is a drag along right will allow you as the founder, being a majority shareholder, assuming that you've kept the majority of shares in the company, to force the remaining minority shareholders, who could well be an investor, to accept an offer from a third party to buy your business. So in effect, you're dragging them with you in the sale. So you don't want that minority investor to be sat there saying, no, I'm not going to let you sell the company, I'm going to stay here, because that could hinder the entire process. Your buyer will just say, well, I don't want to buy 60% of the business, I want to buy 100% of the business. So it's quite important that you have, or at least think about with your investor, having drag along rights in the shareholders agreement, which will then be reflected as well in articles. Conversely, tag along rights are almost the reverse of that, if you like. So it's effectively enabling a minority shareholder to participate in the sale at the same time as the majority shareholder, and at the same price for the value of those shares, if that makes sense. So that's more often than not, a tag along right is something that the investor will probably want to have in there to enable you to tag along with a sale of their shares at the same price and at the same value.
Sure. So there's kind of benefits for each side. One founders in the drag along, and investors perhaps on the tag along side.
Exactly.
So, super. Okay. So those are all the kind of questions that we had set out for this evening's fireside chat. Before we close the session, does anyone have any questions that they'd like to pose to Elle? You can either put them in the chat, or feel free to unmute yourself and ask your question in person.
I have a question.
Okay, Prajesh, you're welcome.
Yeah, first, thank you for that. That was really insightful and a lot more detailed compared to, say, your 60 seconds every Tuesday out. 60 minutes. Pardon my naivety on this, just because there's quite a lot of information to sort of take in. But with regards to clients doing, or a founder doing their due diligence on an investor, is that something that they instruct yourself, for example, to do the due diligence on their offer, or is it something that they instruct, say, Darren, for example, to do financial due diligence, or is that something to do with mergers and acquisition? What steps does that founder need to be doing before, and at what stage as well is that due diligence done?
Due diligence on the investor?
Yeah.
Yeah, that's a really good question, actually, because there's
okay.
Yeah, I mean, there's and actually there's no real right or wrong answer to that, because and actually this is something that Julie, you might be able to help with as well, just given what you do, but that there's never an early enough point at which to do your due diligence. If I'm representing you as the founder, I typically wouldn't necessarily need to be involved in that process, but I absolutely can be if you wanted me to. And the way that I would probably typically go about doing that is to see what other companies or businesses that investor has invested in, and have a little look at, and you might need an accountant to come in and have a look as well. Have a look into those companies. How are they doing? How are they performing? Have there been any legal issues that obviously will need to be publicly available for us to see? Absolutely do a director's search of that investor, find out all of the companies that they are directors of, and indeed shareholders of, because that will give you quite a good picture of how sophisticated they are as well, in terms of their level of investment, how familiar they are with the investment process. So yeah, that's a really good question, and definitely one that you would probably want to get your financial advisor involved with as well, your accountant.
Your accountant, sorry.
Yeah, to have a look at some of the accounts of other businesses that investor has invested in, and just see what's generally publicly available out there, and which we can help you with by looking at Companies House. But yeah, there's quite a bit that you can do early on to look into that investor. So yeah, good question.
So all of this information is,
sorry, go on.
No, I was just going to clarify that this information is publicly available about what this investor has invested in elsewhere. It's not.
Yes, you won't see the contractual terms of that investment agreement or that shareholders agreement, because that isn't available at Companies House. But what you can do is a director search on Companies House, and it will bring up a list of all the companies that investor is a director of. You can then dive a little bit deeper, which I love doing a good old snoop on Companies House. It's a bit sad, I know, but you can then look into that company and see what percentage of shareholding he holds in that company, and then that will probably take you off to another company that you can have a look at. So it's definitely good to do that.
Okay, and then the accounts which are publicly available on Companies House. I know because I've seen them. An accountant can look into that and give his own professional opinion on what he thinks about those other companies he's invested in.
Absolutely. Yes. No, I think that's probably quite an important thing to do as well, because it's all good and well you saying the investor does their DD on you and your business, which quite rightly they need to do. It's also really important that you're taking on the right investor, because depending on how active they want to be within your business, they've got to be the right fit for you. Like as Julie mentioned earlier, you don't want a clash of personalities, because that could be fatal. Personalities and prior experience that could be fatal for your business. So doing your own DD is really important as well.
Yeah, I mean, sorry, really quickly, when we're working with clients who we're preparing to raise investment, we encourage them to really do in-depth research up front, so that they only target investors who are actually likely to invest in them, so they don't take a scattergun approach, but B, they're very sure that the investors that they're talking to meet their criteria for what they want in an investor. And what we often advise them to do, as Elle's saying, is to look at companies that they've invested in before, not just look at their accounts, but go and talk to the founders and find out, before you've even engaged with that investor at all, go and talk to the founders and say, how's it going? What's that been like working with that investor? Would you recommend them? There's quite a lot that you can do up front to find out what's going on. It's also worth finding out not just what they've invested in, but where they've got exits from as well. So, you know, have companies moved successfully through to a good exit, or have they kind of fizzled out? Is a really important point too.
Okay.
Yeah, it is. Good question.
And just a couple of off questions from this topic. What if the investor hasn't invested in a UK company before he's done international investments? Is that something that can still be researched, or is that not?
Oh, I see what you mean. So something that's not immediately available over here, but you still want to do your research on that. So yeah, there are other publicly available registries offshore. So most of them are. I don't think many of them are as easy to use as Companies House, I have to say, but they are available. And again, I've got some experience in dealing with offshore registries as well, so I tend to know which ones are good and not so good. But again, it might be worth taking or getting a local opinion in that country, who will be able to dive a bit deeper into those companies who that investor has invested in, and do a little bit of due diligence offshore as well.
Okay, and if the investor is investing for the first time, this is his first investment, would I be right in saying, you know, that's obviously a bit more risky, and that's a decision for the founder to take at their, you know, their risk, that there's no evidence or due diligence that they can do on that person? Would I be correct in saying that?
Yeah, again, so doing due diligence on the investor, so the investor hasn't invested before, so you want to make sure. I mean, there's always an element of risk involved, and then I think you need to think about weighing up that risk with how much you're willing to give away to that investor. And you can build into your negotiations, your sort of commercial discussions with that investor, that should the company do so well after year one, let's say, of that investment, then you might be in a position to consider giving a little bit more away to that investor further down the line, once he's kind of proved himself or proved themselves to be of benefit to the business. So you can definitely factor that in as well in the investment.
Okay.
Super.
I'll stop asking.
Thank you. No, thank you for those questions, Prajesh. Are there any more questions before we close?
Georgina.
Nope. Oh, Georgina. Oh no, I think, were you going to ask a question, Georgina? Nope, I think that was maybe her just dropping out slightly.
Sure. It's a little bit, connectivity.
Okay, looks like we have no further questions. Thank you everyone for attending this evening. It's been a great chat with Elle. Thank you, Elle, very much
no problem
for your time. So you can find Elle on LinkedIn. It's Elle Berrett, or also via the gunnercooke website as well, if you want to talk to her further following the session. And if you'd like to talk to us further about raising investment, then of course we're available on spark-consulting.co.uk. Thank you everybody, and hope to see you at one of the following sessions. So next week is the importance of brand in raising investment. So all about branding next week. So take care everybody, and good evening. Thank you.
Thanks, Julie. Thanks everybody.
Bye.
Thanks. Bye. Bye.